I think the fears were not justified. It's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business.
What's up, folks? So Silicon Valley Bank has recently failed, stoking fears that other banks are going to fail, the federal government's going to try to do another bailout, and people are going to be screwed. Of course, psychopath and human pimple Jim Cramer just recently told people to buy that stock.
The ninth best performer year to date is SBV Financial, don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SBV is the old Silicon Valley Bank.
The reason I call him a psychopath and yes, a human pimple, he looks like a pimple with a mouth and an opinion, is because I don't forget when Jim Cramer was trying to get the federal government to vaccinate everybody and use the military to do it.
We have immunocompromised people who are incubators for every variant to come, walking around lawfully unvaccinated? That's psychotic. We have companies that have tried hard to get people vaccinated and now backing down. We have governors who want to be president by grandstanding on a foolish states' right issue, the right to get sick, get other people sick. So it's time to admit that we have to go to war against COVID. Require vaccination universally. Have the military run it.
Don't take your financial advice from a pimple with a mouth. Anyway, apparently Silicon Valley Bank had $209 billion in total assets at the end of last year, and this is a massive, massive move. We're gonna talk about it, why it happened, and I have a guest to do so. And second story is Saudi Arabia and Iran are striking a peace deal, and you can guarantee that America and Israel are not thrilled with this move. In fact, classic neocon Max Boot is even apologizing for being a neocon today. Weird. What's going on there? We'll talk about it. Welcome to the Dream Rare Podcast. It's the Dream Rare Podcast. Welcome to the show. The way to get the news at the desk or on the road. Let's go. God is great and success in our control. The world is crazy, but we get better from obstacles. Hey, what's going on, everybody? Welcome to today's episode of the Dream Rare Podcast. I brought on Clint from Liberty Lockdown for a few reasons, but one is I think he understands some of the financial ends of this banking stuff better than me, so thanks for being here.
Yeah, thanks for having me, man. For those that don't know me, I'm host of Liberty Lockdown, and I was a entrepreneur, mortgage broker, private money for 15 years, and retired in my late 30s. So I do know finance, and I got into it in the teeth of the 08-09 collapse. So like I can really talk about this stuff.
We appreciate it because I think it's a huge, huge story. There was hundreds of billions of dollars into this bank, and it failing is asking a lot of questions. Some people think that more banks are going to fail. They possibly might try to do another bailout, which will affect us. And, you know, I'm sure you have a lot to say, and I want to really just let you fly. I just want to play this Bloomberg clip real quick. It's like 40 seconds, and I think it did a pretty solid job. So let's watch.
SVB, like all other banks, are able to hold bonds on their balance sheet, and they can say on their balance sheet that they are worth at cost. They are worth what they had originally bought them at. Of course, that's no longer the case, especially for long duration bonds, which SVB had a lot of. So when you have a panic, when you have VC funds not doing well, they need to take money out, like we have been seeing recently. The issue becomes what happens when you need to liquidate those bonds. SVB at the end of last year said they were worth $91 billion. It's very highly likely they're not actually worth that because the Fed has been hiking rates. So you have this mismatch, and that's how you get this run on the bank potential and the wider fears of does it spill over into.
Yeah, so let it fly. Why do you think it failed? What was the mistake that they made?
Well, it's not really their fault in some ways, because what they did was they took their investor capital, which is the people that are just putting their deposits in the bank, and they put them in long dated treasuries. And they expecting that the Fed would never do what it has done over the past year, which is hike rates very aggressively, more rapidly and more consistently than I have ever seen in my lifetime, and maybe ever. Basically, what that means is that the actual price of those bonds, if you have to sell them before they actually expire, so like say you have a 10-year treasury, well, if the rate on what you bought them at was 1%, but they're now at 5%, you actually take a loss because the expected return is, you know, it's catastrophic. So if you have a run that comes because of, here's the more complicated picture. Because this is a bank in Silicon Valley, what that means is that they have a tremendous amount of their banking customers that are in the crypto space as well as the tech space. Because you have a hiking interest rate cycle, it means that capital is more hard to come by. So that means that these companies that had been keeping deposits with you are suddenly going, well, we need to use our capital because we can't go out and get loans right now. So they start to withdraw. That creates this vicious cycle. As their reserves drop, they start to try and seek liquidity, but the only thing they have left to sell are treasuries, which are way beneath what they should be, because the Fed has hiked rates really aggressively, and then ultimately you end up with a run on the bank as a result, and then it just becomes a catastrophe.
So I guess two questions I have is, one, was it a mistake for them to have so much of their capital in those treasury bonds?
Yeah, because they were longer duration. They were probably going after higher yield by putting them in longer duration, expecting that the Federal Reserve would never do what it did. But if you're a prudent, fiduciary for your investors' capital, they probably should have put them in, 1 or 2 year T-bills so that they wouldn't have gotten in this predicament.
Did they do? I don't know. I didn't see enough of it, but did they do it before 2020, or did they buy some of them after 2020?
That I don't know. I don't know when they actually acquired them, but I would imagine that it was happening in 2019, 2021, and then the Fed just completely pivots and goes into this aggressive hiking cycle in I think it was February of 22, so just 13 months ago. But it has gone from basically zero Fed funds rate up to almost 5% Fed funds rate, and that is just a dramatic shift that I don't think very many people saw coming.
When 2020 happened, we could just replay it real quick. And a lot of people tell me, because of politics, obviously, Trump was in office. I think some people want to tell me let's not talk about the past, let's move on. And it's I'm not someone that's trying to talk about 1940s or something, but when we printed, I don't know if I've seen some reports that said it was 6 trillion, 9 trillion, 10 trillion. They printed so much money during COVID. Was it inevitable that the Fed was going to have to come to this fork in the road eventually, where either we raise interest rates or you get screwed another way?
Yeah, I mean, from the Austrian school perspective, yes. If they want to maintain the purchasing power of the dollar, they're going to have to hike interest rates to try and absorb some of the liquidity from the system. If they had maintained rates at the zero bound, essentially you'd just have people that are borrowing money because it's free and creating additional bubbles in the economy. So they start to hike rates because they want to bring down inflation. Well, then you have all these knock-on effects that start to emerge. And I actually said this a year ago. I said, if you see the Fed funds rate get around 5%, look out below. And I was just it was just a gut call. I didn't have any actual graphs or anything to say that, but I was I just know how this market works because I've been an investor and a player in it for so long. I was if the Fed funds rate gets to 5% and they hover around there or they go north of it, you're going to see insolvencies that strike in places you don't expect, and then you're going to see contagion events. And what a contagion means is that you have counterparty risk between banks. So you have Silicon Valley Bank. Well, some of their assets and some of their debt is held by other banks. And they have some of their deposits that are held by them as well. So if they're insolvent, that means that these other guys are trying to get their capital out. Now they can't get it out. Now their depositors start to sense that maybe there's problems at this bank. You start to get a run on that bank, and that's how you get this contagion effect where you start to see runs on a lot of banks. So I think that the FDIC or the Feds more broadly, or the Federal Reserve itself may intervene and try and stop this over the weekend. That'd be my expectation.
Right. I guess I want to say, when it came to the bailout of the banks in 2008, 2020 was different, but I did feel like there was a big corporate bailout because the government told everyone, you have to shut down. You have to shut down cruises, you have to shut down flights. And then there was essentially, I think, a massive corporate bailout where I think the cheese in the trap was we'll give the corporations trillions of dollars and then everybody will get $1,600. And essentially overnight, we had bipartisan universal basic income. We'll close all your stuff and here's the $1,600, and Boeing gets this money and Royal Caribbean gets this money. From that point on, wasn't it almost inevitable that they were going to have to hike the rates at some point, or am I missing something? Yeah.
No, you're exactly right. I mean, inflation is a product of money creation. That's really what it is. So it requires velocity or circulation of that capital to ultimately create consumer inflation, where the people start to feel it. So it had a lagging effect. So that's the main reason that politicians and central bankers can get away with this stuff, is because the average person goes, well, they printed all this money and we didn't have inflation, so I guess that wasn't it. Well, no, that's totally wrong. It's just because the money hasn't actually gotten into the system yet and created excess demand for goods that have too short of supply. Plus, you have the lockdowns, which break the supply chains, which reduces supply even further. So you have supply of capital that's up and supply of goods that's down. Ultimately, that means that you have an inflationary cycle. So this is all a product of 2020, man. It's all a product of it.
I want to ask some questions because I know a lot of people that are watching this are going to wonder, like, do you think more banks are going to fail? Like, is my money safe? How bad is this going to be? But first, on that note, real quick, I just have to bring it up because it's actually strategic. And I know this, unfortunately, this is going to bother a lot of people. This isn't like a Democrat excuse because they were in on it in 2020 and 2021 also, and Biden's obviously not helping any.
No.
But in general, the funny thing is that strategically, it was actually really good for Republicans to not win presidency in 2020, in my opinion, because now everybody, even a lot of Democrats think, and I would say almost all Republicans are calling it Bidenflation, Bidenflation. But the truth is really the Fed and both parties printed all this money in 2020. In my view, if Republicans took every seat in the world, I mean, her pain was still coming, maybe to a slightly less extent, but the real damage was done in 2020 by McConnell, Pelosi, Trump, Jerome Powell, all of them. And now Republicans kind of get to sit back and point to Biden, and everybody actually believes it. I'm not saying he's like a great person. I'm just saying like the damage was done, and there was nothing to change it after that point.
Well, and Fauci has to take some of the blame here too. I mean, all these people lied through their teeth saying that we can do this and we will not have catastrophic economic consequences, which is just patently false. This is part of the reason I started my show is because I was so furious that they were just lying through their teeth. I'm like, I'm a finance guy. I know for a fact we are going to pay a huge economic price for this, and they just completely discounted it.
Let's talk about like I should have uploaded the clip of all of them saying like it wasn't coming and don't worry. Let's talk about Janet Yellen, right? She's a financial expert. I think she was in during the Obama administration too. I think Biden put her at, what is she, the treasurer? Is that her role?
Yeah, Secretary of the Treasury, I think.
Secretary of the Treasury. I mean, her saying in 2021 that the experts are saying that inflation's not coming and recession's not coming. Like, obviously, with your financial expertise, she has to know she's lying, right?
Here's the weird thing about this. I would assume so. However, these people go to, Keynesian colleges. So like they honestly believe that Keynesian economics is legitimate, and they also believe in modern monetary theory to a large extent. So like I think some of them are drinking their own Kool-Aid, but I can't tell you for sure who is doing that and who's actually just a scumbag or who's an idiot. I don't know which.
Me with I'm not going to say, I mean, I have real life experiences. I got a PhD at the School of Hard Knocks. No, but, on the streets. But, as somebody with basic common sense and semi-understanding, I thought to myself in 2020, just as they were printing all the money and the lockdowns were happening, I was like, I would be happily surprised if the whole, like anything short of our whole thing collapsing is a win to me. And anything short of like full-blown recession would be a win. When they're like, is recession coming? I would have been blown away if there was no sort of recession, because I just have basic understanding of like, well, you printed what? $6-10 trillion and gave everybody money and then shut down the supply chain as you were doing it, as if money printing's not bad enough. You're also shutting down entire supply chains, and you're mandating that entire companies shut down and stay home. I'm thinking to myself, I would love if this didn't collapse our system. And now you're starting to see some of the things. So obviously things have gotten bad. Everyone sees the prices, How bad do you think it's going to get without like overly fear mongering? And is this like a lone bank, or is this bank connected to other banks, or this is going to have a domino effect?